Hi, good evening, ladies and gentlemen. Thank you for joining us at the Corporate Connect webinar this evening. I'm Pauline from SIAS. This webinar is organized by SIAS and supported by SGX. Today, we have with us Mr. Geoff Howie, Market Strategist from SGX, to share with us on market updates, followed by a presentation by Mr. Donald Han, CEO of Sabana REIT. And we will end off with a Q&A session moderated by Mr. Benjamin Goh, Head of Research and Investor Education from SIAS. Without further ado, let us welcome our very first speaker, Mr. Geoff Howie from SGX. Over to you, Geoff.
Okay. Thanks very much, Pauline. And I assume everybody can hear me. Good evening. I'm the SGX market strategist and intend to provide just a quick 15-minute overview of the current market drivers of our stocks and provide a little bit more focus on the REITs ahead of the presentation from Sabana REIT. Must point out, of course, this presentation is designed to be purely informative. The recent observations are on the moves in the stock market, and in no ways is this providing investment advice. And I guess the point must also be made that past performance doesn't guarantee future returns and so forth. So looking into the STI, look, after generating a 12% total return in the first half of this year, the STI so far in the second half of this year has added only a marginal return of 0.3%. That's over the first 4 weeks of the second half. In the meantime, the FTSE ASEAN All Share Index, the regional benchmark represented by the green line in the chart, has declined by 2.4%. Among the STI stocks, CapitaLand has been the strongest performer so far over the past 4 weeks with a 8% gain, and it has attributed its 25% total return this year to the significant restructure to sharpen, obviously, its strategic focus and create this CapitaLand investment, which they tout to be a leading listed real estate investment manager comprising of funds management, lodging management, stakes in listed funds, stakes in unlisted funds, and of course the investment properties. So the CapitaLand Investment EGM and the scheme meeting, it is scheduled for the 10th of August. And if that's approved, the expected date for the delisting of CapitaLand and the listing of CapitaLand investment shares is on or around the 17th of September. Now, within the STI so far in the second half of this year, we've also got Fraser's Logistics and Commercial Trust. We've got Ascendus REIT, we've got Keppel DC REIT, Mapletree Industrial Trust, as well as Mapletree Logistics Trust, among the 10 strongest STI stocks for the past 4 weeks. And this has coincided with the iEdge S-REIT Leaders Index and the FTSE ST REIT Index gaining a little over 2% since the end of June. This, I guess, for the year, this resilient global trade and, of course, the demand for container shipping has seen Yangzijiang Shipbuilding the strongest STI stock in the 2021 year so far. In the first half of this year, the group secured new orders of, I think, of 100 vessels, mostly container ships, worth more than $5 billion US, and that surpassed their previous record largest order wins based on total contract value for an FY in the group's history. And as you would know, the group's been around since the 1950s. The city developments, on the other hand, has been the STI's least performer this year with a 13% decline. Now, for the overarching market driver, the new global confirmed COVID-19 cases, they're currently coming in at around 500,000 cases per day. And while that's off the April high of 900,000 cases per day, we are up from those 300,000 cases per day in the mid to late June. In addition, across the globe, we've not been able to break below that mortality rate of 6,000 persons per day. And I think on the 23rd of July alone, on Friday, the Indonesia country reported over 1,500 confirmed deaths. For the vaccine rollout, momentum growth has also subsided in July. We've had 800 million vaccine doses administered globally in July through to the 25th of July, which compares to 1.14 billion vaccine doses administered in June and 810 million vaccine doses administered in May. So that I guess that momentum growth has subsided. But for Singapore, as maintained by the IMF back in early May, should downside risks materialize more from COVID-19, Singapore does have ample fiscal space to deploy additional policy support, and fiscal policy does continue to be the first line of defense here in Singapore. But I guess as economies draw closer to normalization in this half of the year, the rotations and the interest by active short-term traders is expected to continue as investors look to more macroeconomic cues in addition to, I guess, seeing progress on containing COVID-19. The continued vaccine process, containing the new cases, they will remain key drivers for the service-orientated stocks that have been adversely impacted by the containment measures, and at the same time achieving herd immunities, vaccine equity, the gradual recommencement of international travel and tourism, etc., is expected to increasingly rank higher in global policy agendas, which, as we are seeing, are becoming increasingly multilateral. For the current levels of 31.38, where the STI closed today, the STI would have to rally another 5% to be at its pre-COVID-19 high, near that 32.80 level back on the 17th of January 2020. To reach its May 2018 high of 36.40, the STI would have to rally some 15%, and for the STI to return to its 30 October low, it would have to decline some 23%. Now, right on to REITs. For the past 19 years, since 2002, we in Singapore, we have grown to be one of Asia's largest REIT and property trust markets. We now list 40 trusts, the real estate investment trusts that, so there's 40 trusts. You've got, I think it's 33 real estate investment trusts, 5 staple trusts, and 2 business trusts. And by the end of the first half of this year, at the end on June 30, the combined market value of the S-REIT sector, it stood at 111 billion Singapore dollars, which represented around 12% of the combined market value of all the stocks listed on the Singapore Exchange. So that combined market value of the S-REIT sector, it has grown at a 10-year annualized return rate, compound annual growth rate, I should say, of 9% a year over the past 10 years. And this is not just down to performance, but portfolio growth through acquisitions that, among other methods, can be funded through secondary fundraisings, such as placements and rights issues. And one of the most recent examples is Prime US REIT, which last week announced the completion of the acquisitions of One Town Center in Florida, Sorrento Towers in San Diego's technology hub as well. And the REIT manager utilized an $80 million placement in prime units to partially fund those acquisitions, which I think was more than 2 times subscribed, with strong demand from both existing unit holders and new investors, with a wide mix of investors, long-only institutional investors, multi-strategy funds, family offices, and private wealth clients. And I think that REIT itself, Prime US REIT, will release its first half numbers after the close on the 3rd of August. The S-REIT sector, it's also recognised very much as a regional and more as of late a global REIT hub, and as many as 16 of the trust exclusively invest in property assets outside of Singapore, with 19 of the trust investing in properties in both Singapore and outside of Singapore, and the remaining 5 REITs investing purely in Singapore. And this includes as many as 10 REITs with properties in China, 7 REITs with properties in Japan, and 6 REITs with properties in Malaysia. The trusts are also highly diversified across property types, with a balance across the retail, the industrial, the office and the hospitality properties, in addition to multiple REITs investing in healthcare related properties, as well as specialized REITs such as data centers, which has the Pure Play Keppel DC REIT, Mapletree Industrial Trust, which is around 50% high-tech spec and data centers. And then you have Ascendus REIT, which is now 10% exposed to data centers as well. But globally, industrial REITs have posted median marginal gains in 2020 and then gains again in the 2021 year to date, with the warehouses, the business parks, the logistic efficiency really supported by e-commerce, technology, consumer goods industries, and not to mention trade growth, global trade growth. Industry REITs can play a really important role in international manufacturing supply chains. And as we know in Singapore, manufacturing has been comparatively resilient over the past 12 months. For the past 6 months, it's grown 15%, and that's supported by the rising Asia middle class, consumer economy, urbanization, and of course, advances in technology and e-commerce also deepening the regional supply chains. Yes, the REITs, looking at the metrics, the REITs and property trusts, they average a 12-month trailing dividend yield of 5.5% here. And as of 30th of June, they were trading at an average 3% premium to their book value. That compares globally to a median dividend yield, trailing 12-month dividend yield of 4.4%, which is lower, and a median, sorry, I shouldn't say not global yield. The global yield is a little bit lower than that. But for the APAC region, it's for the 300 or so REITs listed across the APAC region, the median yield is 4.4%. And in terms of the valuation across APAC, the median PB ratio is also 1.03 times for the 300 or so REITs listed across APAC. So across APAC, they also average a similar 3% premium to book value. So what's happening in the REITs these days? Well, back on the 14th of May, when we first announced the heightened measures, the Straits Times Index, it traded its biggest daily range in terms of percentage points since 11th of June last year. And that announcement saw the STI end the week down 4.5%, with global market, what really impacted the REITs more than the STI was that global market swings also saw the 10-year US Treasury yields traded a high of 1.7% on the 13th of May. And that's its highest level all the way from the 7th of April through to the present. So presently, the 10-year US 10-year yields are trading at 1.26%, lower than that 1.7% high on 13 May. So this has increased the yield premium of the FTSE EPRA REIT Developed Index to the US 10-year yields from 155 basis points on the 14th of May to the current premium of 194 basis points. So that means that during the past 10 weeks, REITs were globally among the strongest segments of the global stock market. And that's along with technology stocks and manufacturing stocks as well. Now, the yield premium of REITs to bonds has increased, and at the same time, global inflation concerns have also edged higher, with REITs traditionally touted by NAREIT, and there's some literature on the NAREIT website that you can access that shows in the past how REITs have in the past provided some portfolio protection against inflation. And consequently, from that 14th of May right through to 26th of July, the iEdge S-REIT index generated a 7.5% total return, which outpaced the STI, which gained around 2.5% over that 10-week period. So at the same time, the 3 REIT ETFs or REIT-focused ETFs that we have on the SGX, the Nikko AM Straits Trading Asia ex-Japan REIT ETF, the Lion Phillip S-REIT ETF, as well as the Phillip APAC Div REIT Leader ETF, they also recorded combined inflows of 36 million Singapore dollars over that past 10 weeks. So what that's done is bring the iEdge S-REIT index return to 7% in the year to date. The ARA Logos Logistics Trust has been the strongest performer of the S-REITs, and it was also among the 5 strongest APAC listed REITs in the 2021 year to date, with Sabana REIT actually the second best performing S-REIT in Singapore over the period, over the year to date. And it also ranks, Sabana REIT ranks among the 10 strongest APAC listed REITs in the 2021 year to date so far. And Sabana REIT, which is the focus of tonight's presentation, has generated, I think, around a 28% unit price gain, with dividends boosting the total return of Sabana REIT to around 36%, which I think, if I remember right from the presentation, I'll be very careful here. If I remember right from the presentation I read last week, this was achieved on the REIT delivering on its refresh strategy. So it's now be a good time for me to close off with just one more slide before Mr. Donald Hahn will speak. One of our most recently launched channels is Telegram, and the colloquially termed SGX Invest. We encourage you to find us on Telegram, as the channel does provide us with the means to send you usually once daily, maybe twice daily, relevant insights that may serve to inform you on recent developments in the stock market and the security products and so forth that we have, as well as these upcoming events. And if you do prefer the once a week emails, of course, our SGX My Gateway report has been running for the past 9 years and now has a pretty wide subscriber reach. And we distribute that every Monday night at around 7 p.m. and try and collate as much information across the industry that we can, and obviously have that at your in your email box every Monday night. So I'll finish off here and back over to you, Pauline, if you want to bring Mr. Donald Hahn on. Thank you.
Thank you. Thanks, Geoff. That's really a good summary and good insights, for all of us. So thanks for coming on tonight. Without further ado, let us welcome Mr. Donald Hahn, CEO of Sabana REIT. He will share with us more about the company, enhancing what Geoff have actually mentioned earlier. Over to you, sir.
Thank you very much, Pauline. I hope everyone can hear me loud and clear. And good evening, everybody, again. And thanks, Geoff. I enjoyed your presentation. Good to note that Sabana, after working so hard, we are ranked, I think, second under in the last 6 months in Singapore and top 10 in Asia Pacific. Shows that our refresh strategy certainly is paying dividend. I would like to go through our presentation, which we prepared specially for this SIAS Facebook interaction. It will take about 10 minutes. If I can just run through some of the highlights as what we have presented in our news or in our press release for financials on the 22nd of July. This is just a recap on that. Just to introduce those of you who are not so familiar on Sabana, we have 18 diversified portfolios in strategic locations. It is an industrial REIT. All of them are located in Singapore. So we are within the 5 REITs in Singapore, as Geoff mentioned, who are focused only in Singapore. A lot of properties, the bulk of them are located in the high-tech industrial segment. We have properties in the warehouse, logistic, chemical, and logistics sector, as well as general industry, which makes up about close to 862 million worth of portfolio valuation. And about more than half of our properties are actually located within 20 minutes walk from nearest MRT. So that helps to actually to create opportunity for accessibility for our tenants. Next slide. This gives you a resilient portfolio at glance. Number of 18 properties. We've got total occupancy of 83%, and total number of tenants is about 148 tenants. We have renewed and we have new leases over the last 6 months, transpired about 750,000 square feet. Reversion, rental reversion is 11.8%, which I believe one of the highest we've achieved among some of peer REITs. We've announced results so far. Our WALE is about 2.8 years. On the next slide, it gives you a performance based on our refresh strategy. We have seen generally double-digit increases in first half of 2021 on a year-to-year comparison. On gross revenue up by 14.1%, net property income up by 23%. In terms of our amount available for distribution, up 41%. Our DPU for first half has actually increased by 214% of about 1.48 cents in that sense. Yeah. Next slide. We got a lot of pictures that shows you, NTP Plus. I hope all of you will have an opportunity to visit this wonderful mall of ours over here. Now, just to give an idea of what our refresh strategy, when I came on board as CEO of Sabana REIT in 2018, we came up with a strategy to be able to focus on what we want to do, to be able to get into an end result where I think now we are starting to see some of the fruits of our labor, the seeds planted in 2018. In the first phase here, we are actually in 2018, 2019, we were looking into strategizing, looking at our portfolio. At that point in time, we've got 20 properties. We were looking at divesting some of our assets, which is mature, non-strategic, and continue to optimize our portfolio occupancy. And we did that in 2019. We actually sold 2 of our assets to a tune of about 100 million. And we used that to pair off our debt. And at the same time, we actually started phase 2, which is your asset enhancement. And that started with the construction of our new tech park, which we only achieved our TOP completion first quarter of this 2021. And moving forward, of course, in phase 3, we didn't quite define as to what our timeline will be. It could be, next year, for instance, where we look into potentially yield accretive acquisitions, which includes investing in overseas assets. Next slide. Just to provide some strategic update on progressing in the next phase of growth, we came out with a slew of announcement on the 22nd of July, which basically focus on what we intend to do to be able to strengthen the REIT further. And part of this, which will be discussed later on, is removal of Shari'ah compliant, and mainly because of what we are right now. We're looking at potentially increasing our capital management, proactive capital management, where we have already signed a new facility loan agreement of up to 225 million. No refinancing until 2024. And we are resuming our distribution reinvestment plan, which is simply called DRP, to be able to enable unit holders to participate in long-term growth of the REIT. And at the same time, we have also strengthened the stewardship of our ID, Mr. Charlie Chan, who just joined us from the current 2. Next slide. So we focus on this removal of Shari'ah compliant. Why now? I think it's important to note that it's a very tough decision for us to take this particular step of removing Shari'ah compliant, who has been embedded in the culture of Sabana REIT for many, many years since inception. The intent is really we're grateful for what Sabana REIT as compliance, Shari'ah compliant has provided in the ecosystem, and to build what Sabana REIT is right now in terms of branding, in terms of positioning on a global Shari'ah compliant REIT status. The main reason is really because there has been changing profile of our tenants, and especially with the completion of NTP Plus, we have new F&B that started operating. And we want to also ensure that it can enhance flexibility in positioning Sabana REIT in the next phase of growth. So as mentioned, we have undertaken this decision after feedback from unit holders over the many, many years through AGM sessions. We had done feasibility studies, we have done strategic analysis of growth opportunities as well. So with the removal of the Shari'ah compliant mandate, we will be known as Sabana Industrial Real Estate Investment Trust. And this is likely to transpire sometime around 21st of October 2021. So despite removing the Shari'ah compliance, we're exploring options to remain as Shari'ah friendly, a viable investment for Shari'ah investors, and potentially still remain in relevant indices and all that. Next slide. Again, this is one of the reasons why we have got a change in some of our tenant mix with the completion of NTP Plus. If you look at the highlighted in circle, our F&B and retail tenants have actually increased by about 11.5% of our total gross rental income by segregation by trade sectors. Just take note, our F&B component from NTP Plus is much lesser than 11.5%. This includes retail, which includes retail of a corporate HQ, which is located in some of our industrial buildings as well. So why is this significant? Again, the fact is that the removal of Shari'ah compliant requirement helps to enhance our balance sheet resilience. We are able now to be able to get, for instance, loan from foreign banks, for instance, and the more banks available to be able to compete for us, hopefully that can help to provide more competitive loan rates as well. It's also to be able to create investor diversification base. More investors would be able to invest in an entity which is non-Shari'ah, in particular Sabana Industrial Real Estate Investment Trust. There's also greater flexibility in capturing growth opportunities and delivering our refresh strategy. So we want to be able to capture on tenants, for instance, who are previously non-Shari'ah compliant, for instance, banks, insurance companies. In the past, a lot of these banks, before we've done our refresh strategy, asset enhancement, rejuvenation, we are not a target for a lot of these banks who are moving back from operations from the CBD. But now the fact that, for instance, we have completed on asset enhancement for New Tech Park, it becomes a viable option for some of these financial institutions who are able to pay higher rental to be able to come and move some of its backroom operations into our industrial. So it becomes more relevant right now, especially now that we have completed the first and second phase of our AEI for New Tech Park and some of other portfolios as well. And the fourth important consideration is because over time, Shari'ah compliance has a cost. But if you add this all up together in many years, there will potentially be a potential cost savings in the long run as well. On the next slide, we are always keeping an eye on proactive capital management. We have just entered into a new loan facility agreement for up to 225 million in unsecured loan. Prior to that, we did not have as much. In fact, all our loans are on secured basis. Why is this significant? Well, mainly because it refinances our majority of our secured indebtedness, and general work is this mainly to create a greater headroom for general corporate and working capital needs. It also helps to increase our weighted average debt expiry, with the majority now of our borrowings is turning unencumbered. And with this new loan facility of 225 million, our next refinancing is in 2024. So it's still work in progress as we're trying to, currently we've got about 60% of all our loans, which is unsecured. It's work in progress to be able to get this moving up to as much as 100% if possible. On the next slide, we're building our capital reserves and we are resuming DRP to enable unit holders to participate in the longer term. Now we have got this resolution for DRP was overwhelmingly approved in our April 2021 AGM, where we are now able to, unit holders are able to partake on distribution, DPU, in a form of units rather than cash. And obviously the advantage for DRP for this is unit holders will be able to partake on a discount from the average trading price. And this also helped to create liquidity into the market as well, so that the more liquidity it is, certainly will invite more institutional, larger investors to come in and to be able to propel this into higher indexes. Next slide. Again, the significance of this is for the unit holders to ensure that you increase your unit holding without having to pay brokerage costs, transaction costs, and all that. For the REIT, it increases and strengthens our working capital reserve, conserve cash from operations, and create financial flexibility. On the next slide, please. We have looking into strengthening. We have actually strengthened our stewardship with the appointment of Mr. Chan Wai Kiong as our independent director. Next slide. And this is effective from 2nd June 2021. Mr. Chan has extensive capital market experience of over 35 years, and he used to be the MD of Credit Suisse. On the next slide, please. This gives you an idea of our portfolio rejuvenation and AEI of what we've done so far, which has contributed to the robust performance so far this year. Just to run through this, some of the rejuvenations that we're doing is really to attract tenants who are in the expansionary sectors. And some of these would include in 151 Lorong Chuan, we have actually started with rejuvenation of some of the passenger lifts and toilets. On 8 Commonwealth, we have completed first phase of the lobby upgrading. Now we're doing another set of common areas, which is phase 2, which is currently underway. For 23 Serangoon North Avenue 5, which is one of our best performing assets, where I think valuation has increased by almost 20% in the last 12 months. We have completed the upgrading works for lobby areas and all that. So valuation, yeah, so maybe the previous slide. Yeah, so in 10 Changi, we are also have completed some of the lobby upgrading progress as well. One of our property, which is 3032 Tuas Avenue 8, which is currently vacant, is now under advanced negotiation for with potential master tenant. And at the same time, we are undergoing preliminary studies for a few strategic projects like 1 Tuas Avenue 4, while it's under divestment, potential for, we're also keeping an eye for potential redevelopment or build to suit for potential tenant. 10 Changi South Street 2, we are engaging stakeholders in the vicinity to see what we can build in the area. And at the same time, 151 Lorong Chuan, phase 3, in engaging the authorities to build underutilized plot ratio of about 200,000 square feet. Again, this is not immediate, but we are engaging it. The fruits of this might only be seen in the next 1, 2, maybe even 3 years in a sense, but we'll keep the market informed when there's material updates to be announced. Next slide. This shows on some of the works that we've done in terms of AEI and rejuvenation. 4 portfolios that I've mentioned have already seen an increase in valuation. On the left, New Tech Park have increased by about 5% to 350 million by virtue of the new mall completing. 23 Serangoon North Avenue 5, 10% up in the last 6 months, and another 10% in the second half of 2020. 10 Changi, we saw an improve in occupancy and valuations up by 8% just in the last 6 months. And we've seen an increase in valuation for 8 Commonwealth of 2.8%. Next slide. So you're looking into a positive catalyst. I think the key catalyst that actually created improved performance is really NTP Plus, the retail mall, where we completed this on budget, and we completed in first quarter of this year. And we started to onboard tenants. And occupancy stood at 97.4% as at 30th June 2021. And we are working hard to, there's only 1 unit that's vacant, and we're working hard to fill this up. So all this transpired during heightened alert measures. And we continue at the same time, while the mall is operating, we will continue to support business continuity of tenants, while focusing, of course, health and well-being of all stakeholders, including mall patrons. This is our first NTP Plus. If you look, it's under a green mark, BCA certified. It's our first property which has such a certification. Next slide, please. So looking to fast forward, we move forward. Next slide. These are some of the tenants that we have managed to expand and concluded the expansionary tenants that contribute to huge, performance in our own general GDP economy. In the electronic sector, we have onboarded AEM. We have onboarded global testing chip test chip testing company, KLA Corporation, Vico, which is also an electronic company, and ASML, which is a Netherlands headquartered global company in 151 Lorong Chuan. On the healthcare sector, we have onboarded Thermo Fisher Scientific at 3A Jukun. We have data center, which we just onboarded and they're still expanding in 151 Lorong Chuan. And under the logistic supply management, we have Carry Logistic, who have expanded and renewed in our building. Next slide. This, I think, my last slide, just to key outlook. Singapore economy is expected to recover, but I think we are conscious that we're a small country dependent on the macroeconomics landscape, which still is challenging, and we don't know how this variance is going to emerge, COVID-19 variants. Obviously, on our side, we are in a good position after we are committed on our refresh strategy. We have delivered part of the refresh strategy. We are in phase 2 right now, and you can see the results that have borne some of the improvement in our metrics performance. While we are confident, we are also conscious that there's much work that needs to be done. It's work in progress, and certainly we look forward to entrenching in alignment with our unit holders to deliver long-term sustainable value to all our unit holders. I think that's the end of my presentation. If I look forward to this Q&A with SIAS and with you ladies and gentlemen as well. Over to you, Pauline.
Well, Benjamin has already come on board. We'll start our Q&A session. So for viewers watching Facebook Live, you may post your questions in the Facebook comment section below. And due to time constraint, we will endeavor to answer them as many as we could. So I'll hand it over to Benjamin, our Head of Research and Investor Education from SIAS, and also continue the Q&A with Mr. Donald Han. Over to you,
Thank you, Pauline. First off, thank you very much for joining us, Mr. Han. We are very appreciative for listed companies to kind of talk to our members, and I think Sabana is, of course, very interesting simply because of its growth trajectory over the last few years, and shall we say the merger with the proposed merger last year didn't go so well, but I think the management strategy, as you have articulated in the refresh strategy, that's quite a significant pivot. So maybe the first question could be on that as well. So we have got a refresh strategy, but again, arguably, a lot of REITs investors are very, focused on the size of the portfolio. So given your refresh strategy as well as your current financials, can management provide more clarity and color on its ability to grow its asset base? So you have a debt headroom. Is that possible to grow? And what do you think the growth of the AUM is?
Yeah, thanks, Benjamin. So if you're looking at my entire strategy or refresh strategies, I mean, the numbers that we see in first half are the encouraging numbers. It's a result of 3 years of hard work, hard labor, and a lot, I think, depend very much on the execution. While we are one of the smaller REITs in that sense, we are focused on ensuring that we strengthen the REIT now, and part of the strategy is really to ensure we have got strong backing headroom from our financiers in that sense. So part of the strategy of getting our new loan facility agreement signed at 225 million to get 60% of our debt unsecured, which means now we can talk to more banks to be able to increase that headroom. For us to be able to target on tenants in specific sectors to be able to onboard on us, which is not easy. Yeah? They've got a lot of other property landlords, larger landlords than us, neighboring on our property, who would also do a sweet deal. But they chose us in that sense, which I think is important because I think it's that relationship that we have with tenants. And these tenants are what we call AAA grade tenants who are in the expansionary sector, which means once they are there in the building, when they pump in their fit out and their infrastructure, they will stay where they are in that sense. So we hope we have them locked in over a period of time, and that helps to fill up our occupancy. Even at 83% occupancy, we're not there yet. I want to get it up as high as 88%, 89, or even 90%. GDC's average occupancy is about 90%. So we'll get there. It'll take time for us to do, but to get there, we need to do more asset enhancements. That's what we've done. I've done for our largest portfolio, which is NTP New Tech Park, to make it more attractive for multinationals to come in, to attract all the electronics, data centers. I need to make it a little bit more attractive to create integrated use. So we put in retail, F&B, we have a gym there. So tenants like to have everything all under one roof, so to speak. And that brought interesting tenants. And that's also the reason why we are proposing to go into removing the Shari'ah compliant, because we're starting to have interest coming from financial institutions willing to take large chunk of space in our building. So as part of a strategy, we are also not only focusing on New Tech Park, which is 40% of the portfolio, we are also looking at other strategic buildings that are of interest to expansionary tenants. Like your 23, we have already completed the upgrading Rejuvenation. We're doing 8 Commonwealth, we're doing 10 Changi as well. So all this is part and parcel of us ensuring that when the first thing we do is to increase occupancy first. We are not where we are. I think we're getting where we are. I'm still not happy, but I want to get as high as possible, 88 to about 90% in line with the market. And then after that, we want to ensure that our loan is fully on an unsecured basis. And then with a flexibility for us to be able to position ourselves for potential growth, which could be the next 12 months or so, definitely from 2022 onwards. Benjamin, I hope I answered your questions.
I think that's that provides a lot of narrative actually, and certainly the results of the refresh strategy is self-evident because we've pulled out data from Bloomberg and all that. The year-to-date total return stands about close to 27%. That's like one quarter. That's huge. And of course, the dividend yield is standing about 6.4. So again, very good numbers. So I think I guess if you take a look at the results, the early results of the refresh strategy, I think that's certainly very, very optimistic. And I think our participants here are quite happy with that as well. Just now you talked a little bit about the NTP Plus, right? So we do have a question. NTP Plus is obviously a piece of property that is focused on the electronics as well as technology segments. So what do you think would be the return and risk factors associated with having a piece of property that's solely focused on that particular sector?
Okay, let me just clarify. NTP Plus is actually the mall which has about 60% of F&B. You got a food court, you've got some retail units, and you've got the gym as well. So that's NTP Plus, which is about 40,000 square feet of gross floor area. The other component, which is a larger 800,000 square feet, is actually New Tech Park, which is like a business park. It's an industrial B1 category. And that is a component that we're starting to see more electronic companies, global electronic companies are coming there to put their headquarters. And these companies are coming from some of the larger REIT buildings nearby. So we used to be what we call a flight out of quality. When I first came in 2018, New Tech Park, we had tenants moving out because they say, hey, there's nothing to do over here. There's nothing to eat. Lunchtime, we have to go out. We just have a canteen in that sense. But all that has changed right now. Now we are flight into quality. People are coming to us from wherever they are, from peer REITs. And we're proud of that because it shows that we are now transformed. It's moving an uptick cycle, and we're moving in circle back into demand. And that being said, I think, of course, on our side, while part of our job is to ensure that we diversify any of our portfolio so that none of the portfolio really have got one or two main components. So in New Tech Park, for instance, there are tenants who are in the technology sector. There are those which are in the retail or F&B. Within the office component, there are corporate retail, F&B is office is located over there. There are companies which are in the algorithms. There are companies in research and all that. So I think that is a good mix to have. It's also, but what we're seeing in the last 6-9 months has been a slew of electronic companies that's starting to move over here. And I think it just shows that, the demand parameters, what we've built NTP to be all-encompassing, integrated, is starting to show the rewards by seeing names which we love, any landlord would love to have, starting to, to be onboarded in our portfolio. And that's just an example. There are many of those, like in 23 Serangoon and in 8 Commonwealth, that has got similar kind of expansionary tenants that we're targeting upon. Benjamin?
Okay, thank you very much for that. We do have a few questions that's coming in live through our social media and so on and so forth. Maybe we should just move to those sure. In the interest of time. We do have a question, and it's quite a specific question. Is there any intention from Sabana REIT to acquire cold storage facilities?
Okay, good question. There are portfolios which are in demand, but very few in supply. Cold storage is one of them. I think the total supply of cold storage facility is less than 10% of the whole industrial stock in Singapore. And even if you want to buy, you probably have to pay a very high price for it. So the easier way is to look into adaptive reuse of your existing warehouse facility to be able to convert this, to do asset enhancement and to do some of this cold storage amenity. If you look at one of my presentation, I might not have gone through it. 3 of our properties in Penjuru, which is a logistic area, have seen the sharpest drop in property values. I think it dropped between about 2% to 4% in that sense, as opposed to most of our portfolio have seen an increase. I think the main reason is, of course, most of our properties in that area are all old, about 18 years old, around there. It's time to do some asset enhancement. And a lot of our industrial properties in that area are all what we call facilitated by cargo lifts, which means only the ground floor is attractive. And there are a lot of supply in that area with new warehouse which is being built on a ramp up. Ramp up means every floor is like a ground floor because your container truck can go all the way to the 5th or 6th floor. So one possible angle would be, of course, to relook into adaptive reuse, maintaining what the building is currently, but to improvise into specification. So one possibility is to put in cold storage, which is part of our evaluation process anyway. But the problem with cold storage is that, in warehouse, you don't have, there isn't enough power. Warehouse is not built to have a lot of power. It's meant to store passive goods in that sense. It's only the industrial property has got. So we have to be selective to see which property has got high power generation that can potentially improve on transforming some of our property warehouse into cold storage. Again, we've got to work on the numbers, and we've got to plan which are the properties and whether or not we can do it. It's a function of finding the demand as well, and to do it concurrently. With the demand there, we do it concurrently. I don't want to build a cold storage warehouse and there's no demand for it, or if I price myself too high. So it's work in progress. But again, it's all about the current positioning that we have right now. We are positioning ourselves for the future. That by removing our Shari'ah compliant, I can target any particular group of tenant. They can be in a halal business or non-halal business of storing goods, for instance. So that's important for us. We are positioning our debt, again, greater flexibility, higher debt headroom by signing on this 225 million. So there's huge opportunity for us to be able to do what we want to do through asset enhancement first, through adaptive reuse. And again, it could be at some point of time, maybe next year onwards, we can start looking into acquisition mode. Certainly cold storage facilities is one interesting proposition, as one of your viewers have mentioned.
Okay, and I guess this is certainly a benefit of the refresh strategy, where you can remain nimble and be on the lookout for any kind of market opportunity.
Absolutely, Benjamin.
Okay, that's great. We do have the next question, and I think you talked about it a little bit just now during the presentation. It is about the BCA Green Mark. So will Sabana REIT be looking at more sustainable properties going forward, and have some of your buildings already been converted or have achieved the BCA Green Mark?
If I've got a wish, I want to convert all mine into a green mark. But the problem here is that, again, you have to be realistic. We are one of the smallest REIT in town. But we can do a good job of whatever we do. I mean, if there's one thing we've proven ourselves, we execute well and within budget. Okay, I intend to keep it that way in the next many years. In that sense, despite COVID-19, despite disruption in the supply chain of construction costs and all that. So obviously for us to get green mark, it's easier to redevelop rather than to do asset enhancement or additions and alterations, because you're still talking about old chiller system, old building. You know, it's like trying to give a Miss Universe award to an old person, or you know, and that person is still old. But it's easier to rebrand it from new in that sense. So part and parcel of the challenge is a lot of our buildings are old. So we are also evaluating in some cases if there's an opportunity for us to do redevelopment. So one possibility, as I've mentioned, is 1 Tuas Avenue 4, where we are now thinking maybe we should look into developing our first ramp-up property, or we could go into building cold storage property. And as we build from scratch, from ground up, there is an easier process of getting the BCA green mark, because it's built from fresh. You're not transforming an old building or old person into a potential crowning glory in that sense.
Okay, it looks like I won't be winning the Mr. Universe anytime soon as well. No, but I hear you. Okay. Let me quickly just go to the last few questions. Sure. Okay, so Sabana REIT is going to be delinking its you know, from the Shari'ah compliance. So one question is there any potential issues or risk do you foresee when you do that?
I mean, we are very thankful for the ecosystem that Shari'ah compliant has given. Like I say, it took 3 years to decide on this after immense consultation with various unit holders, doing feasibility studies and all that. But we think the time is now, you know, because our mall is ready, and now we're looking at how we can attract, you know, non-Shari'ah tenant like banks, insurance to come, who able to pay higher rental. We've created a special communication line for any of the affected unit holders. So far, I can safely say that there hasn't been any negative feedback, and we are quite encouraged with that. And like I said, we are prepared to, we're seeking to see whether we can continue to be Shari'ah friendly. Overnight, nothing has changed. Technically speaking, I'm not getting into any business of converting my tenant mix. My tenants, what it is right now, I've got 83–84% of my tenant mix. Not going to change in the next, you know, 6–9 months. And the likelihood it'll continue to be that same vein of tenants going in. But it creates that flexibility for me to be able to offer the same space to other tenants, which is also in competition with other REITs. Other REITs also want the same kind of tenant. So by delinking the Shari'ah, I'm putting myself on a level playing field. I'm also be able to, you know, from 2022 onwards, if I were to look into investment opportunity, it allows me to be able to evaluate all other options as well. It could be backroom operations of a bank, financial institution, campuses, and which are sorely, you know, which a lot of investors are looking for. So again, the intent here is that as we create an opportunity of flexibility, growth opportunity for us, we don't want to be inhibited by Shari'ah moving forward as we focus on creating a larger REIT moving into the future.
Well, I mean, that's certainly very comforting, right? Because obviously being Shari'ah compliant is one of the I mean, as you mentioned, it's slightly different from the other REITs, and you know, in a way, it kind of binds your business strategy. Yeah. So, you know, without any, I guess, risk associated with delinking that, I think that's quite reassuring to investors.
But I must say that even with Shari'ah compliant, we are ranked as one of the I mean, it gives me branding. It's one of the largest real estate investment trusts in the world. I mean, that's good to have. But even though I'm the smallest in Singapore, it gives me bragging rights, you know. But again, we are appreciative of the ecosystem and the branding and recognition that Shari'ah compliant has provided for Sabana REIT in the many years.
Okay. There was a question, and this related to that, being Shari'ah compliant. You use the term Shari'ah friendly. Is there a legal or practical distinction?
It's colloquial, It's colloquial. Okay. it's like my mall. There are some halal. There are some halal, like I've got the Penyet, which is one of the best ayam penyet in Singapore. It's halal. Then there is my Dutch colony, which is coffee. It's run by a few enterprising. The barista is a Muslim, all right, and it's deemed as Sharia friendly. Yeah, so it depends lah. I mean, for those who are not, you can still take coffee there lah. You can trust because you got a Muslim that's handling the barista and all that. But it's up to the individual. So for us, like I said, nothing will change in the next 6-12 months. I'm not immediately taking out all my electronic companies and putting banks inside. The tenants will still remain. I just want to create the flexibility to get other tenants where in the past, have not knocked on my door, but now are knocking on my door, willing to pay higher rental. So in that sense, depending on the complexity or the discipline of the Shari'ah investor, they might say, yeah, sure, Sabana, okay lah, all right lah, Dutch colony coffee I can drink lah. So that's what we want to be, Shari'ah friendly to some of our affected investors, because technically nothing much will happen or change in the next 12 months in that sense.
Okay. We have a question about the cost of debt. So one participant has written that it is comparatively high, and he thinks it's about more than 3%. I'm not sure whether it's true. What is your risk exposure to future interest rate increases?
Well, we are susceptible to any increases lah. I mean, we are takers of loans, but what we managed to do over here, our loan rate has actually, cost of funds have actually remained almost the same as reported in the first quarter interim business update. And if you look at it, I think technically one will have to pay more if you convert your secured loan into unsecured. So we have converted 60% of our loan into unsecured and maintain that level, the same level of cost of financing. And to be fair, the bank that has given us this new facility, which is UOB, it's the same bank that serviced us in the many last 5-10 years. It's not a new bank come out from somewhere and offered us something. I think the difference really, even our stakeholder, which is our banks, have also recognized that we are transforming. We have executed well in our refresh strategy. We have delivered, NTP plus. We have not only delivered the end product, but we put in almost full occupancy for a retail project, which is very hard to rent in today's market because of the difficulty that retail F&B tenants are experiencing. But again, we managed to do it, and despite not having the experience in doing it. So again, all this works well, and to have what we achieve with a bank, to achieve that kind of cost of funds without having to pay more, I think it's kudos to my finance team in that sense. But of course, we are watchful to make sure that our cost of funds, we want to keep it as low as possible, but we are in a uplifting interest rate environment. But like I say, it's still work in progress to convert the rest of our 40% loan into secured in that sense in the next months or 6 months in that sense.
I guess you just all money and then you can put into a project that does phenomenally well, then why not, right?
Yes, absolutely.
Okay, we only have got on my clock about 2 minutes left. Maybe we'll just take one more question and then we can close the Q&A session. Sure. Okay, the question is, who are your major tenants? When are their leases due for renewal? I guess the concern here is that if all of them renew at the same time or they don't renew, then that would be a issue with the occupancy rate.
So our tenant lease expiries is well tapered in that sense. In fact, this year I have about, overall, when I started this year, we've got about 20% of lease expiring in 2021. By the time we hit middle of the year, we have already cured 75% of all my leases that's due for expiry. Either I have renewed them or I replaced them with another tenant. So I only have about 25% left in the next 6 months. And so much so that I'm now starting to take care of my 2022 lease renewals as well. Okay, we have to look after them because we want them to stay and all that. So if you look at next year's lease renewal, we've got about roughly 25% of my leases. So a lot of leases are signed on a 3 years basis. So you can expect 1/3 expire every year. So we have the fact that we have got 20% this year, 25% next year. It shows that a lot of our leases are signed on a slightly longer period, some on 5 years, some on 4 years in that sense. So the line is fairly flat. We've got 20, 25, 20, and maybe 25 in that sense. So we are in comfortable position. What you don't want is for you to have 90% of your lease expiring next 12 months and 10% expiring next year, then you've got a lot of work to do in the next 12 months in that sense. So very comfortable. So the person that asked this question, I'd like to reassure that Sabana REIT, we have proactively managed our lease management to ensure that all our leases don't all expire in one particular period of time, but it's well spread out in that sense to minimize risk.
Yeah, certainly you don't have a balloon suddenly.
No balloon. Yeah, right, correct.
Okay. All right, that is all the time that we have for Mr. Han. Thank you very much for answering our questions.
My pleasure, Benjamin. Thank you for having me. Thank you, Pauline, as well.
Pauline, do you have any closing remarks or anything you want to show?
Not really. Just want to thank, Donna again for taking the time tonight, to actually share a lot on this. For those who actually missed tonight's event, just come to SIAS Facebook page. You're able to rewatch them. We will also be putting them on our Facebook, YouTube as well. So the video will be available. And so we just want to wish everybody good night. And the next Corporate Connects on the 17th of August. It will be a lunchtime talk. And yep, we'll look forward for everyone to participate next month. And we hope to have Mr. Donahan with us again, in future, if there's a chance. And thank you very much for watching, everyone. Good night.
Good night, everybody. Thank you for having me. Bye-bye.
Thank you, Mr. Han.
Good night.
Good night.